大家好，我们现在看 Upstart 的财报，它刚刚发，我也刚刚看了一眼啊。我们首先看一下它上个季度的对这个季度的预期，收入是基本上是300个 million 啊，295到305啊，中间就是300。然后 net income 就是会计的利润是大概20个 million 左右，然后调整过的 EBITDA 是应该这是57啊，所以这是几个数字。然后全年的是1.4，然后contribution margin 跟原来差不多45%。然后我们看一下它这个季度的真正的数字，以及对后面的预期这些 OK。收入是310，310，6高于预期10个 million， 所以这个 OK。然后 net income 是32，这个也比预想的要好，就比管理层的预期要好一些。然后 contribution profits 47%，这也差不多 OK。所以就是总体来讲，就是第一季度刚刚结束第一季度。跟预想的差不多，然后比管理层的预期稍微有超出，这也在意想之中。然后我觉得市场可能主要反应是对第二季度的预期。管理层现在第二季度预期是收入又是300个 million， 就是跟现在的第一季度是基本一样的。然后 contribution margin 贡献利润是45%，这个好像比我感觉上稍微低一点点。net income 是-4到0，所以基本上是下个季度 break even。这个可能要看管理层怎么讲。我的感觉，我的理解是，因为它可能是很多auto 以及新的产品的投入，所以这个对我来讲不是太大问题。调整过的净利润是 OK， 所以就是总体从利润上的角度，就是说二季度比一季度相比。收入可能会差不多，至少现在看起来，让利润比刚刚报告的一季度要略差。但有一个问题我需要管理层给解释，就是说为什么对第二季度的流通股的预期跟现在的股数，我的印象里差不多96，我回头看一下。所以这个要看他对自己的股票回购怎么解释，应该。在这样的价格，如果是它有400个 million $4亿美金的回购的话，数字应该比这个要低才对。然后，所以就是二季度的，我觉得我的两个问题是说，从收入上为什么比原先，就是利润上为什么比估计的要少？第二个就是股票回购，他们是什么样的结构，什么样的节奏啊？然后对全年来讲，这个有点问题，就是收入现在是1.25。刚才这个是1.4，就是全年预期，管理层比原先的预期略少了0.15，对吧？就150个 million。然后其他的这两个利润的数字反而差不多，我的感觉是。所以总体来看的话 ，OK， 现在股市反应应该是很差，就是我觉得主要是对第二季度的预期。可能是不管是从收入上还是从利润上都达不到预期，加上现在整体大盘这种情况，所以会有很激烈的反应。但是我觉得关键的在于管理层给的那个 context， 就是他给的什么样的解释。比如说这个收入如果是华尔街预期比这个高一点，然后它低一点，为什么？利润为什么？比如现在有不错盈利，下个季度可能利润几乎没有以及就是回购的节奏，他们是现在已经开始了。我的认为是，但是他要确认，以及为什么他们认为到第二季度结束，整个流通股数还不会有大量的下降。看一下这是96个 million 这是稀释后的，就是所有的股票是96个 million， 上个季度。印象里好像也是这个数字 ，OK， 稍微有下降。这是上个季度就是Q4 是98.8，所以变成96 ，OK 有下降，但是没有我感觉上应该下降那么多。 400个 million，然后如果是70块钱，应该可以回购不少。所以呢，我的感觉是，总体我还要听管理层的看法。如果是他没有特别的解释，就这个2季度至少是从利润上是有点失望的啊。但是他如果解释是说他有很多投资啊，就是未来的加速，这有可能可以解释。其他的现在还看不出来。我觉得现在市场的反应是最开始的可能是吃惊的反应，再加上现在数字的问题。我觉得主要还是要看管理层对第2季度的它的营收回购，然后以及全年跟之前的预期有什么不同。看一下大家有什么具体问题吗？可能也都在消化这个数字当中。对，它主要的问题就是前瞻不及预期，就是它对全年以及是现在主要集中的第2季度的那个指引上不够。1季度的整个营收没有问题。所以就是 CEO 的信心就来自于这是为什么说电话会议重要啊？电话会议就是让你有一个平台，你可以跟华尔街以及跟普通的投资者去解释啊，就是是什么样的数字，为什么是这样的数字，对未来什么预期，那为什么有些地方可能不如大家想象中那么好？我现在登录一下它那个 earning call。不知道为什么每个公司都要登记这些东西。OK， 我们等一下它开始啊。没有，它刚上市的价格，我印象里比这个还要，它现在除非跌到20几块，要不然它上市时候应该是20几块。但是现在这2天的价格很有意思，然后好像过去3天，好像纳斯达克跌了，感觉上好像超过10%，好像。所以我的感觉是，我们1年以后再看这个价格，这即便不是谷底，也应该离谷底很近了啊。所以，这种时间过了就好了。所以关键还是要看公司的基本面有没有变化，就是说这家公司，比如它现有的产品是不是仍然在迅速发展？那它要做的，比如说 auto， 它肯定会讲说它汽车的贷款进展怎么样，然后以及其他的，因为它今年还要上市其他几个产品，对吧？就是那个个人小金额贷款、个人小额贷款以及商业贷款。公司在之前还没有真正介绍，但是现在我们进入第2季度，它应该也会给介绍说，现在什么进展。所以我们要知道它这个全年的预期是现在整个情况现在这么，就是好像感觉不明朗啊，因为那利率上升，大家好像每个人都在估计，利率上升的同时，然后经济危机也会来，所以管理层是不是针对这个要过于谨慎，还是有别的原因？这个都要听管理层的解释才能知道。 我个人的猜测啊，你看 CEO 的他这个 opening remark 很重要啊，他就是整个给公司指引，就是说第一个就是当然是比较正面的，就是说连续第7个有利润的季度，然后连续第4个，然后增长超过100%的季度啊，这当然都是非常不错的业绩。但是呢，后面这个可能这是他对全年指引可能有下降的原因，就是今年现在看起来会对经济会是challenging one，challenging one 不知道怎么解释，就是富有挑战啊。但是呢，我们知道怎么应付，然后我们不管2022年带给我们的是什么啊，我们也会很有信心可以 navigate， 可以顺利的度过去所以呢，就是我的猜测啊，它以后可能会主要的我觉得不是公司的问题，而是出于谨慎，它有可能会放缓一点它的产品，以及放缓一下它比如说个人无抵押贷款这些的增长，就是主要为了避免这个，如果是真的产生大幅度的经济下滑就是我之前讲过，就任何公司没有很少有公司一个行业是说经济下滑的时候反而表现更好的，多数都会有问题就是至少会比原先表现要差一些。所以在这种情况下，很多管理层就会提前刹车他会看这个情况，然后就是把那个增长稍微放缓一点，然后让自己稍微有个过渡。所以这是我个人的猜测，一会听一下管理层到底怎么讲，因为不觉得他公司基本面有什么真正的改变。OK， 所以我个人的猜测还是宏观，然后因为我跟你讲过，就是你看那个鲍威尔他的那个 Fed Chair， 他去讲也是讲，就是说我们不知道未来会怎么样，所以他现在他的整个对经济的掌控就像怎么比喻，就像我觉得就像那个新加坡这种防疫一样，就是他会走2步退1步，然后看情况再说。比如他可能会提一下利率，然后再看一段，然后看到底对经济什么影响，再决定下一个。所以他没有很清楚的讲说我们未来一定要比如提到什么程度或者什么样，有没有。所以这种情况下呢，就是说每个公司管理层都要有自己的判断。所以呢，如果是从这个总的经济这个判断，如果从原先就是整体是非常快速的复苏，比如说6个月之前可能是大家都是说现在是快速复苏，现在6个月之后多数人感觉是说现在更为复杂不知道利息怎么样，不知道通胀怎么样，不知道可能就是如果今年不会，明年会不会有经济萧条。如果在这样的情况下，管理层调整它的增长率也是情有可原。对，所以我主要的会看他管理层对他的那个回购的那个力度。我其实是希望他回购，不仅说我们已经在，而且会继续大幅回购。我希望他其实能够增加回购的额度。对，这个股价就是这样的，就是我觉得还是应该着重点还是在这家公司基本面如何，就是说任何公司你让它平稳的就是持续增长但是这个前面的道路，然后总会有磕磕绊绊，所以这些不是要 focus 的问题。有蚊子咬我。这种震荡，我觉得这种震荡怎么就是心态嘛？就是说你如果是说，比如说我如果之前买到 Palantir 我可能会现在很慌，比如说 Open Door 跟 Upstart 我就不太慌就是说心情你说好吗？当然不是好的嘛，就是我还是希望它大涨，但是呢，你知道这家公司长期没有问题的话，就是这种股价的波动短期间的其实你看过去就完了。这个问说回购跟拓展业务哪个最重要？我觉得这要取决于那个回购的那个 回购的那个空间，对吧？如果是它股价真的是跌到40以下，我觉得把所有的那个自由现金流都用来回购，我觉得就很划算啊。因为它的120的时候还发行过股票，所以你想想你的40多块，如果可以啊，可以回购，然后120，然后再发行新股啊，当然这个顺序是反的，所以这样其实对公司非常划算。这总共才1年多的时间，对吧？那我不觉得基本面有问题，就还要看管理层怎么表示，但是至少现在看起来，就他只是说把全年的指引比现在稍微有点下降，对吧？然后利润是不是下降？我觉得我之前讲过，这个对他如果是能快速增长，比如说每个季度仍然100%左右的速度增长，它利润是高一点还是低一点，只要有利润，我觉得都不是太大问题。我们先听一下管理层怎么说吧，我一会儿再回答这个 JC 的问题。OK。
Today's call is being recorded. At this time, I would like to turn the call over to Jason Schmidt, Vice President Investor Relations. Please go ahead, sir.
Good afternoon, and thank you for joining us on today's conference call to discuss Upstart's first quarter 2022 financial results. With us on today's call are Dave Gerard, Upstart's Chief Executive Officer, and Sanjay Datta, our Chief Financial Officer. Before we begin, I'd like to remind you that shortly after the market closed today, Upstart issued a press release announcing its first quarter 2022 financial results and published an investor relations presentation. Both are available on our investor relations website, ir.upstart.com. During the call, we will make forward-looking statements, such as guidance for the second quarter and full year 2022, related to our business and our plans to expand our platform in the future. These statements are based on our current expectations and information available as of today, and are subject to a variety of risks, uncertainties, and assumptions. Actual results may differ materially as a result of various risk factors that have been described in our filings with the SEC. As a result, we caution you against placing undue reliance on these forward-looking statements. We assume no obligation to update any forward-looking statements as a result of new information or future events, except as required by law. In addition, during today's call, unless otherwise stated, references to our results are provided as non-GAAP financial measures and are reconciled to our GAAP results, which can be found in the earnings release and supplemental tables. To ensure that we address as many analyst questions as possible during the call, we request that you please limit yourself to one initial question and one follow-up. Later this quarter, Upstart will be participating in Barclays Emerging Payments and FinTech Forum, May 16th, Citi Beyond the Basics Conference, May 24th, BofA Securities Global Technology Conference, June 8th, and Morgan Stanley Technology, Media, and Telecom Conference, June 14. We will also be holding our annual stockholders meeting on May 17th. Now I'd like to turn it over to Dave Gerard, CEO of Upstart.
Good afternoon, everyone. Thank you for joining us on our earnings call covering our first quarter 2022 results. I'm Dave Gerard, co-founder and CEO of Upstart. I'm pleased to say we're off to a great start in 2022. The Upstart team just delivered our 7th consecutive profitable quarter and our 4th straight quarter with triple-digit year-on-year revenue growth. As the recognized innovator in AI lending, we continue to expand our leadership position in personal lending and are now off and running in our auto lending product as well. Despite the macro headwinds that appeared over the first quarter, we saw loan transactions of more than $4.5 billion, a record for the Upstart platform and perhaps for the industry as a whole. At the same time, we added a huge number of lenders and car dealerships during Q1. Today, we have more than 500 dealerships on Upstart, as well as 57 banks and credit unions, which is up from 42 when I last updated you in February. At this point, we're adding about a lender per week. This is real progress, considering we had just 10 lenders on the platform when Upstart IPO'd in December 2020. Additionally, we now have 11 lenders with no minimum FICO score in their credit policies. up from 7 the last time we spoke. I'm confident that our momentum and pipeline for both dealerships and lenders has never been stronger. We continue to make rapid progress with our auto refinance product as well. In the first quarter, we transacted more than 11,000 auto refi loans on our platform, almost twice as many as we did in all of 2021. We also launched our first AI model for auto refi that is partially trained by our own auto lending performance data. This kicks off the process of building and deploying increasingly accurate versions of our model, which is our primary source of competitive advantage in the market. In Q1, we also more than doubled the rate of instant approvals for auto refi applicants, another major step toward increasing funnel throughput and delivering a differentiated product experience. Of course, in the recent weeks and months, it's become apparent that 2022 is shaping up to be a challenging one for the economy and for the financial services industry in particular. In my remarks in our February earnings call, I mentioned that the Omicron variant, the clear signs of inflation, and the Fed's plans to counter it, and the market rotation out of high-growth technology. Since then, it's become clearer just how aggressive the Fed will be with interest rates in order to combat a level of inflation that we haven't seen in decades. The 2-year Treasury note, which is the most relevant industry benchmark for our business, has risen more than 200 basis points since October. And of course, the war in Ukraine and the zero COVID policy in China have only increased the risks and uncertainties facing the global economy. As I said in February, lending is a cyclical industry and always will be. So we expect volume and pricing on our platform to vary accordingly. As a result of the increased risk in the economy, as well as the corresponding higher returns demanded by banks and credit investors, the average loan pricing on our platform has increased more than 300 basis points since October. In addition to increasing rates for approved borrowers, this also has the effect of lowering approval rates for applicants on the margin. Given the hawkish signals from the Fed, we anticipate prices will move even higher later this year, which would have the effect of reducing our transaction volume, all else being equal. But if you've been following Upstart for a while, you know that we've been through several disruptions in our industry over the years. And each time Upstart gained market share and emerged a stronger company. When the economy gets turbulent and nimbleness is at a premium, the advantages of a founder-led company with a closely knit and tenured leadership team become apparent. And that's what you have in Upstart. 3 founders involved in the business day in and day out, and a proven leadership team, half of which have been with Upstart almost since inception. I'm proud of how Upstart performed in the last 2 years, particularly during an economic cycle with no precedent. In the worst year of the pandemic, 2020, Upstart grew revenue 42% and generated a modest profit. And of course, our growth rate and our profits since then have been extraordinary by any measure. Even in this challenging environment of 2022, our guidance for full-year revenue implies a growth rate of 47% over 2021, and we expect to be cash flow positive. With respect to credit performance, we're pleased how our models performed on behalf of our lenders during this tumultuous period. While not perfect, our models significantly outperformed traditional FICO-based risk models and learned quickly while doing so. For Upstart loans originated and funded by our banks and credit union partners, we saw significant overperformance since the beginning of COVID, which has normalized to on-target performance in recent months. There has been no meaningful underperformance of returns with any of our more than 50 lending partners since the program's inception in 2018, despite significant periods of economic disruption. For loans funded by institutions and capital markets, we've observed more volatility, which is natural given their broader risk aperture. The unprecedented level of government stimulus caused the majority of these post-COVID vintages to overperform significantly. The abrupt termination of these stimulus programs has caused some of the more recent vintages to underperform. And finally, we're confident that our models are currently well calibrated to the latest consumer credit conditions, performing in line with expectations and are more accurate than at any time in our history. Let's turn now to our new product efforts. One of our most important initiatives for 2022 is the accelerated rollout of our auto retail product. Since acquiring Prodigy in April of 2021, we expanded our dealership footprint from about 100 rooftops at the time of the acquisition to more than 500 today, making Upstart one of the fastest growing auto retail software in the industry. Upstart's active dealership footprint over the last 90 days spans 35 different OEMs, including Toyota, Subaru, and VW. At this point, we're also well into phase 2, which is the introduction of Upstart-powered loans into our auto retail software. This represents the next critical step in modernizing the car buying experience. Without question, our early progress in delivering loans through our retail software has exceeded our most optimistic expectations. While lending is enabled in just a handful of dealerships in California, the uptake and win rate for the loan product, technically termed a retail installment contract, has been far better than anticipated. Our auto teams are working quickly to smooth some of the product edges, filling in a few missing features and completing integrations with various legacy dealer systems, all in the interest of moving toward a broad-based rollout. Our goal is to enable lending in a few dozen dealerships in 4 states this quarter, representing about 25% of the U.S. population, followed by a full nationwide rollout in Q3. Based on what we now know, we expect the auto retail lending business to contribute meaningfully to Upstart's monthly transaction volumes by the end of the year, setting us up for a significant ramp in 2023. As I've said before, auto retail is perhaps the largest of all buy now, pay later markets. So this is one of the most exciting developments in Upstart's history. You should feel confident that we have a lot of executive attention on getting it right. I'm also pleased to share that we began publicly testing our small dollar loan product in the past few weeks. I first mentioned this to you in our earnings call last November. It's designed to help consumers with unexpected and immediate cash flow. Think a few $100s repaid in just a few months. But it's also important to remember that we're building a bank-ready product at bank-friendly APRs, always operating within the 36% rate cap prescribed to nationally chartered banks and to those who serve U.S. military service members. This is a strategic initiative to our mission to improve access to credit, and we believe it will accelerate the pace at which we can bring more and more marginalized Americans into the mainstream banking system. Well, I told you in November that we aim to launch the small dollar loan before the end of 2022. Our small dollar team set an aggressive goal to launch the product by the end of Q1, and I'm pleased to report that they achieved this ambitious goal. Of course, we still have lots of work to do to realize the opportunity in small dollar lending, but the team's ambition is inspiring. Additionally, I'm happy to share that our small business lending team is likewise making impressive progress and is aiming to have their product in the market within a few months. The first version of our Smb Pricing Model will include more than 500 variables about both the applicant and the business. It will also feature our loan month modeling framework, which is one of the most impactful innovations added to our personal loan product a few years back. Our initial testing suggests that version 1 of our Smb model will deliver higher accuracy as measured by area under the curve, or AUC, than peer models that have been in the market for years. We'll begin to cautiously test this new product in the second half of the year. I'm excited about our Smb product for 2 reasons. First, business lending is central to far more banks than is consumer lending, so our bank partners are ready and waiting for this. And second, despite the interest banks have in business lending, the FDIC data suggests that 77% of large banks and almost 90% of small banks have no online application process whatsoever. We're also hard at work on some fundamental upgrades to the infrastructure that underpins our AI models and how we develop them. It's important to realize that the surface area over which we're implementing AI has expanded dramatically. First, we're now working on 7 or 8 unique models that target different aspects of credit targeting and origination. And we're implementing these different models across 5 different credit products as of now. Second, the amount and types of data used to train our models has grown exponentially and will continue to do so. As such, the time and processing power required to retrain our models has similarly increased. So naturally, the opportunity to improve the infrastructure we use to build, train, and deploy AI models is enormous. In an effort broadly referred to internally as machine learning to heaven, or ML2H, we're working to dramatically upgrade this infrastructure. Our goals with ML2H are to allow hundreds of research scientists to seamlessly and securely build new models and add data to existing models, train and test them in an automated fashion, and deploy them across the entire model ecosystem simultaneously. The system we're working toward will provide maximum leverage to our research scientists, productizing and automating how new models are trained, tested, and deployed. Another important area we're investigating is the means by which our AI models include assumptions about the macroeconomy. While our models have long considered the current macro context at the time a loan is priced, we've consistently said that we aren't and don't aim to be macro forecasters. And yet macro events will always have some degree of impact on the performance of Upstart-powered loans. So given our product is designed to target a particular return to lending partners, that implies there's always some view of the macro future inherent in our models. Given this reality, we intend for our product to explicitly share the macro adjustments that are embedded in the models, and furthermore, to allow our partners to input their own macro assumptions. This will provide significantly more transparency to our lending partners, and will also put our focus squarely on risk ranking, which is the heart of what makes Upstart's models unique. A few weeks back, we celebrated Upstart's 10th anniversary. It was a wonderful opportunity to remember all we've been through, to stop for a moment to reflect on how we got where we are today, and to share the gratitude that I feel for all those who have been part of that journey, our employees, past and present, our investors and partners, and of course, our friends and families that made this all possible. Some of the old timers, the OG Upstarters, if you will, shared some of their favorite moments in Upstart history. We talked about the street curb we sat on for lunch each day in our Palo Alto office because we had no better place to gather. When I had the chance to speak to the team, I told them that I'm not particularly adept at celebrating the past. It's just not me. I'm far too excited about and paranoid about the future to spend too much time toasting to our success in the past. As we shifted toward talking about the future, I told our team we need to act with urgency today with a healthy dose of paranoia. We're a company grounded in reality, with our eyes wide open as to the evolving risks we see in the industry and in the world. And at the same time, we have to pair this urgency about the present with optimism and absolute determination about the future. Fortunately, most of our leadership team has been here, so we know the drill and are confident that we can navigate whatever 2022 and beyond might hold. And we know we can blend that urgency for today with the optimistic eye on the horizon. Because although we serve a cyclical industry, we represent a secular change that the financial services industry desperately needs. Artificial intelligence will reshape the economics of lending in ways that will reverberate for decades. We're today pursuing opportunities that represent more than $6 trillion in annual origination. So there's little question about the scale of the addressable market. We see a clear path to building a company with more than $10 billion in revenue in the coming years, and are maniacally focused on achieving that goal. Thank you, and now I'd like to turn it over to Sanjay, our Chief Financial Officer, to walk through our Q1 financial results and guidance. Sanjay?
Thank you, Dave, and thanks to everyone for being with us today. Just to quickly call out the key financial trends before diving into the more detailed numbers. On the top line, origination volumes and revenue from fees were both slightly up from last quarter, which was encouraging given the seasonal drop we typically see in Q1. Profitability was ahead of guidance, but as anticipated, down sequentially from last quarter, partly due to the ramp of auto lending. We've continued to deploy our balance sheet assertively in the service of R&D in both auto lending and new segments of personal lending, as well as using it to smooth fluctuations in funding of core personal loans. And as Dave outlined, the macro environment has become an increasing headwind to growth this past quarter, with both rising interest rates and rising consumer delinquencies putting downward pressure on conversion. With these dynamics in mind, here now is a summary of our numbers. Net revenues in Q1 came in at $310 million, up 156% year over year. Revenue from fees constituted $314 million of that amount, representing 101% of overall revenue, and up 9% sequentially from last quarter. Net interest income was a negative component of net revenue this quarter, as the loan assets on our balance sheet, which we mark to market each quarter, sustained declines in valuation due to the rising interest rate environment. The volume of loan transactions across our platform in Q1 was approximately 465,000 loans, up 174% year over year, and representing over 350,000 new borrowers. Average loan size was up 18% over last quarter, an indication for us that fundamental loan demand from borrowers is back on the rise after being suppressed for more than a year due to government stimulus. Our contribution margin, a non-GAAP metric which we define as revenue from fees minus variable costs for borrower acquisition, verification, and servicing, declined from 52% in Q4 to 47% in Q1, a level which was nonetheless 100 basis points above guidance. Our declining contribution margin was almost entirely a function of the expected ramp in auto lending, which remains contribution negative at this early stage. Without the effect of auto loans, our contribution margin for personal lending would have clocked in at a robust 51%. Operating expenses were $275 million in Q1, growing 13% sequentially over Q4. Sales and marketing and customer operations spend, both typically viewed as variable costs, each outgrew revenue this quarter at 16 and 18% Q-on-Q respectively, due to the additional onus of acquiring and onboarding auto loans. Engineering and product development grew 8% sequentially due to slower hiring than targeted and remains our priority area of investment. Growth in general and administrative spend grew 3% sequentially. Taken together, these components resulted in Q1 GAAP net income of $32.7 million, up 224% year-on-year and above our guidance, but down 44% sequentially from Q4. Similarly, adjusted EBITDA exceeded guidance at $62.6 million and grew 198% year-on-year, but slid 31% quarter-over-quarter. Adjusted earnings per share for Q1 was 61 cents, based on a diluted weighted average share count of 95.5 million. We ended the quarter with $1 billion in restricted and unrestricted cash, down from $1.2 billion at the end of last year, as more of our capital base flowed into loan assets in support of R&D programs, primarily in auto refi and some newer segments of personal loans. Additionally, we have started to selectively use our capital as a funding buffer for core personal loans in periods of interest rate fluctuation where the market clearing price is in flux. Our balance of loans, notes, and residuals at the end of the quarter was consequently up to $604 million from $261 million in Q4. Since our prior earnings release, the level of uncertainty in the macro environment has continued to grow. After remaining at historically low levels for the past 18 months, loan default rates rose quite abruptly towards the end of last year and are now back to, or in some cases above, pre-pandemic levels. This is a dynamic we have observed consistently across the full breadth of our portfolio, although one which appears to be disproportionately impacting higher risk tiers, which are generally composed of borrowers who one might assume have a greater exposure to loss of government stimulus. As a way to keep investors abreast of such credit trends, we have introduced new information in our investor materials, which shows in aggregate for all historical vintages the in-period loan defaults compared to the aggregate defaults that were predicted across those vintages at the time of their origination. The drop and subsequent reversal in default trend that is shown on the chart are, in our view, a function of the injection and subsequent waning of the government stimulus. And as a consequence, virtually all of our pre-2021 vintages will substantially outperform their return targets, while the 2 or 3 vintages most adjacent to the reversal in trend at the end of 2021 are set to underperform. Separately, interest rates have continued to climb in response to inflation signals and Fed tightening. The combination of inflation and monetary tightening imply the non-trivial risk of a recession potentially later this year. Given the general macro uncertainties and the emerging prospect of a recession later this year, we have deemed it prudent to reflect a higher degree of conservatism in our forward expectations. With this as context, for Q2 of 2022, we are expecting revenues of $295 to $305 million, representing year-over-year growth rate of 55% at the midpoint, contribution margin of approximately 45%, net income of -$4 to $0 million, adjusted net income of $28 to $30 million, adjusted EBITDA of $32 to $34 million, and a diluted weighted average share count of approximately 96.2 million shares. For the full year 2022, we now expect revenue of approximately $1.25 billion, representing a growth rate of approximately 47% from the prior year, down from $1.4 billion guided last quarter. Contribution margin of approximately 48%, adjusted EBITDA of approximately 15%. Our thanks once again to everyone at Upstart who is working hard to move our mission forward. And with that, Dave and I are now happy to open the call to any questions. Operator, back to you.
Thank you. Ladies and gentlemen, if you would like to ask a question, please signal by pressing star 1 on your telephone keypad. If you're using a speakerphone, please make sure your mute function is turned off to allow your signal to reach our equipment. Again, press star 1 to ask a question. We take our first question from Ramsey El-Assal with Barclays. Your line is open. Please go ahead.
Hi, thanks for taking my question this evening. My first question is on the conversion rate. It came in a little lower than our model. And Sanjay, I know you mentioned that some higher delinquency rates might be putting some pressure there. So I guess first in quarter, maybe talk about the sort of puts and takes with the conversion rate, and then also what should we be expecting as we move forward throughout the year?
Hey, Ramsey, this is Sanjay. Yeah, thanks for the question. I think it's related what we just described, which is two things: that the rates, the interest rates in the economy go up, and consequently, risk hurdles for banks and for institutional buyers go up. And similarly, as we've talked about, between roughly November and February, delinquencies in the economy reverted as well. They have been unnaturally low for about 18 months, and with the waning of the government stimulus, in our view, those trends have reversed, and those two things result in higher rates, interest rates quoted to consumers, and that results in lower conversion. So I think that's the totality of the story. How that plays out for the rest of the year, I think, is a function of those two things. We view the reversal in the delinquency trends to be stable now, and it has been stable for about 60 days in our view. There is as I said, there's the prospect of higher rate hikes, or I guess higher interest rates. To now the end of the year, there is a risk of something like a recession as inflation plays out and as the Fed continues to tighten. And so, those two things could present further risk to the conversion rates. But I guess it would sort of depend on your view of how the macro environment will evolve for the rest of the year.
Fair enough. I also want to ask you about the ABS side of your business. You mentioned that you'd seen some dislocation that sort of worked its way, back to something more normal. I guess talk about the demand environment for your loans as we stand today, and then also maybe clarify whether you foresee needing to incur any kind of residual liabilities or any other kind of hand-holding measures in order to get those transactions kind of consummated, or whether you think the environment's not really going to demand that as we move forward.
Yeah, sure. So the broader picture on loan demand, so as you know, there's a variety of different channels by which the loans get funded. I think that the loans that are getting funded through bank balance sheets or credit union balance sheets, I would say, is among the more resilient, because they have a cost of funds from their deposits that tends to be a little bit insulated from the way that the yield curves are moving in the economy. And then we have buyers that are a part of the institutional world that are buying and holding on balance sheet, and I would say those are a little bit more exposed to interest rate movements in the economy, but still somewhat resilient. And then there's the amount of the loans that are getting, from those buyers sent to the ABS markets, and that's a fraction that has changed historically as a result of how constructive the ABS markets have been. Obviously, the ABS markets in 2021 were historically constructive, so you could make a very healthy gain by purchasing a loan and selling it into the ABS world, and so a lot of that activity happened. That opportunity, as rates have tightened and this cost of funding has gone up, is far less today. And so the amount of product getting sent to the ABS markets is a lot less in 2022 than it was in 2021. But I don't think that really changes our equation with respect to how we participate in the ABS markets. We've always been a little bit at arm's length in the sense that it's not our balance sheet that's contributing meaningfully to those ABS deals. It is, loan buyers and investors and other institutions that are making the decision to contribute or not. And we don't really retain any residual risk in those deals, and it's not our plan to do so going forward.
Perfect. Thank you very much for your answers.
Thank you, Ramsey.
We take our next question from Pete Christiansen with Citi.
Good evening. Thanks for the question. Dave, Sanjay, I was just hoping we can elaborate a little bit on that last comment Sanjay made about, I guess, credit trends seem to be stable the last 60 days. If you look at some of the rollovers on delinquencies, I guess there's some concern that you could trigger some of the ABS C&L thresholds. Just wondering if there's a concern there at some point, and could this impact your ability to attract funding? Then just my second question, Sanjay, you mentioned you've upped the balance sheet risk here a little bit. How far are you willing to go in terms of supporting new loans and putting warehouse liabilities on the balance sheet?
Yeah, hey Pete, thanks for the question. This is Sanjay. Let's see, your first question is about the pattern of delinquencies and ABS triggers. The delinquencies, just sort of in absolute level, as I said, sort of they renormalized to pre-pandemic levels fairly abruptly starting in October, November. I think that pattern stabilized in sort of roughly February to us. March and April were very stable months. The question of triggers on ABS deals, so it's a somewhat technical thing, but what will breach triggers on an ABS deal aren't the sort of in-period delinquencies, but it's the charge-offs from delinquencies of prior months. We've done some modeling on that. I think that with respect to our large ABS deals, I don't think there's much concern of breaching triggers. We do some smaller monthly sort of pass-through issuance, and there is a possibility that those triggers will be breached. That's a somewhat technical thing. It basically means that the resid holders, are locked out of cash flows for, a couple of months while the bond holders get, replenished, and then the cash flows begin to flow again. So it would impact their returns. And it's not something that rises to the level of seriousness of us, worrying about ability to traffic those deals. I think it's sort of a temporary technical thing that will cause some interruption of cash flows between bondholders and residual holders. So, and then your second question is how we plan to use our balance sheet. And as I said, historically our balance sheet has been almost exclusively for the purpose of R&D. We have used our balance sheet in the last quarter to do what I call sort of a market clearing mechanism. And by that, what I mean is when interest rates in the economy change quite quickly, I think it would be fair to say that our platform, its ability to react to the new market clearing price is probably not as nimble as we would like. It's somewhat manual. It requires a bunch of conversations and phone calls. And so when interest rates move and investors are each deciding what their new return hurdles are, there can be a gap or a delay in responding to the funding, and that's a situation where we've chosen to sort of step in with our balance sheet and almost sort of bridge to the new market clearing price. And as that is happening often and abruptly, we've been sort of playing that role with our balance sheet. I don't view that to be a long-term or necessarily sizable activity for us. I think that developing the mechanisms to respond more nimbly to new price discovery as rates change is something that's on our roadmap, and it's something that we want to start to invest in so that it can happen in a much more automated way. At the end of the day, we view our platform as being a platform that responds to risk and rates in the environment, and so the faster we can do that, the faster we'll be able to sort of deliver the new returns in any given scenario to the investors and not have to bridge it with our own balance sheet. So I would view it through that lens.
Thank you, Sanjay.
Thanks, Pete.
Next question from Simon Clinch with Atlantic Equities.
Hi, Sanjay. Hi, David. So I just wanted to, in terms of your guidance for the year, you're explicitly, I believe, building in a recession scenario later in the year. So I was wondering if you could help us just sort of bridge the gap to sort of what's changed in terms of the mix of your loans. You talked about before having embedded $1.5 billion of auto loans for the year. What's changed there? What's changed on the personal loan side? And then I'll have a follow-up just probably on the last points you were making.
Okay.
Sure, this is Dave. I might as well jump in at least once here. I think it's actually fairly simple. We expect less volume than we would have a few months ago based on pricing in the marketplace being higher. And that's a function of both underlying base rates, being higher, as well as the risk in the environment and the risk premium that either lenders or investors are demanding. So you put that all together and it's been an increase in, sort of average rate to the consumer of several hundred basis points. And I think I've always said we're not in some sense a terribly interest rate sensitive thing. And we've kind of said, interest rate changes of 50 or 100 basis points are something that could well be offset by improvements to our platform. But in this case, it's much more significant than that. And of course, in the last few months, we've seen, and it is probably 300 basis points or higher. And so that's what's giving us, our guidance for the rest of the year. We're not in no way predicting a recession or anything like that. It's not really our job to try to do that. We're just reflecting the prevailing rates in the marketplace and the loan transactions that typically translates to, and that's what you're seeing there.
Okay. And just to follow on the last point, I'm kind of surprised to hear that you're using your balance sheet to put some loans on there which aren't just for R&D purposes. And it strikes me as it's just not a normal course of business for you, given you're a platform business for banks. So I'm just wondering what kind of message that might send to your bank partners or to others in the system. Just curious about that. Thanks.
Look, I think it's Sanjay kind of explained this. In general, we view ourselves as a marketplace where ultimately price discovery happens and loans are funded or not funded when they make sense by our bank partners or by capital markets, institutional investors, et cetera. Some of this works very fluidly, particularly on the bank and the credit union side, where they have very direct controls to change their return hurdles, et cetera. We don't have those mechanisms in place as well on the other side. It's more of a manual process. So when something changes as quickly as it did and interest rates and the risk premiums in the market changed very rapidly, then we stepped in to sort of bridge that, but it's sort of a temporary thing. And as Sanjay said, it is an intention of ours to make the system more automated and more fluid, so we don't have any need to do that. It's not part of our business to hold loans and generate net interest income from loans in our balance sheet, but we certainly want to make sure there's fluidity in the system. And we're definitely going to do some more work so we can do that without any of our balance sheet participation in that.
And Simon, just to maybe put the numbers into context, I think the amount of the total platform loans that ended up on our balance sheet this quarter was still a single-digit percentage. And of that amount, probably close to 3/4 of it was still R&D style spending on predominantly auto loans and other new products and segments. So there was still a relative minority, for a relatively small percentage. But it is just sort of an important new thing that we haven't been doing in prior quarters just because of the fluidity of the environment.
Understood. Okay. Thank you.
We take our next question from Andrew Wood with GMP Securities.
Hi, thanks for taking the questions. As we think about rising interest rates that you're offering, can you just help us understand the spread between what consumers are replacing, right? So if I think about credit card rates going up and other credit card products also rising, are you guys implying that the spread between what is being refinanced is just broadening out and widening? Can you help me understand that? And then secondly, as we think about auto refinancing, there are clearly some headwinds going on there with auto prices coming down, rates coming higher. How are you thinking about the auto refi business for 2022? Can you just double click on that? Thanks so much.
Sure. Thanks, Andrew. On the first question, I mean, it's actually fairly straightforward, and it's not even as, you don't have to think as deep as like what a person might be refinancing through an Upstart-powered loan. It's really as simple as when the consumer rates go up, that means on the margin, a whole bunch of people that would have been approved are no longer approved. So there's a whole bunch of just loans that never happen at all. And there's a bunch of people that are still approved, but the interest rate is a few percentage points higher. And a certain fraction of them are going to just decide that's not the product that they want. They don't need it. It's in many cases, it's a discretionary loan where they're buying something or paying off something that they don't necessarily have to. So there's a fair degree of price sensitivity, and just put those together. When average rates go up, you're going to see less volume. When average rates go down, you're going to see more volume. There's a lot of things we're, of course, doing in the mix of that to make the funnel more efficient and more performant. But all else being equal, of course, if rates go up, those are the effects that you're seeing there. On auto refi, I would just say there's a lot in flux because it is a new product and because it's also a refi product, meaning it has interest rate sensitivity to it. So a little hard to judge how those things will balance over the course of the year. And that's kind of, it's a new product for us. We don't have as much history as we do in personal lending. But certainly, again, it's an interest rate sensitive product, so that works against us. But we're also making some pretty rapid progress in terms of automating people refinancing loans, getting much more focused on digital signatures away from wet signatures, et cetera, et cetera. So there's been some really good progress there. But how those will trade off over the course of the year is just a little hard to predict right now.
Thank you.
We take our next question from Vincent Caintic with Stephens.
Hey, thanks for taking my questions. I appreciate all the products you're rolling out and to talk about the addressable market, but I guess the biggest investor worries on the funding side and not having the funding to fuel your origination volume. So two parts question. So first on that balance sheet, $600 million. Understanding it's not supposed to be a long-term thing, but if you can maybe size what your appetite is. And I guess my understanding was that only loans that were approved by the funding partners were to be originated. So I'm just wondering what's different there. And then secondly, if you can talk about kind of the funding partnership. So, how is interest? I saw that you had 15 new bank partners this quarter. So if you could talk about that. And then the forward flow agreements, if you could talk about, your conversations with your institutional investors. Thank you.
Yeah, sure. Maybe I'll start off on the institutional side. I don't think we have a specific target or number in mind with respect to how we're managing our balance sheet. I mean, it's sort of an ongoing trade-off between, wanting to spend those dollars on R&D and new products to sort of incubate new models and calibrate new models versus buffering the core business through interest rate shocks while we're waiting or sort of investing, making the platform sort of more nimble to reacting to finding those market clearing rates. And how we balance the two is I would say a bit of a fluid equation. So I don't think we have an easy heuristic on how we would sort of prioritize the two. But certainly in Q1 with all the volatility we saw, even though I would say that the majority of our balance sheet spending was still of the R&D flavor, just making sure that the core business was stable, continued to be an important component for us. And I don't know, Dave, do you want to talk a little bit about the lending partners side?
Yeah, we actually had a phenomenal quarter, significantly our best ever in terms of signing up new lending partners and deploying them as well. So doing exceptionally well, particularly with credit unions. So I think both in terms of what we signed up and deployed onto the platform, as well as what our current pipeline looks like, has never been stronger. So we're extremely pleased with the progress we made. We're adding about one lender every week. And I think there's certainly an opportunity to accelerate from there. So, lender adoption has certainly been a highlight.
Okay, thank you. And just a follow-up question on the guidance. So the revenue adjustment to your guide, is that all transaction volume, or is there any change to assumptions to your take rate? And if you wouldn't mind, if you do kind of have an assumption for your transaction volume, that'd be helpful. Thank you.
Volume, but I think I would say the entire difference is transaction revenue related. We don't have any explicit assumptions on balance sheet or any of that nature.
Okay, thank you.
We move to Mike Ng with Goldman Sachs.
Hey, good afternoon. Thanks for the question. So I just had a follow-up on the revenue outlook change. It sounds like it was mostly driven by a lower origination outlook due to lower demand from rising rates. I just wanted to see if you're seeing any change in the lending parameters or shrinking of the credit box due to what's happening on the funding side.
Hi, Mike. This is Dave. No, I don't think there's any significant change in that regard. I would say generally most on the banks and credit union side, there's been very little movement in any direction, and I would say, in some cases they've raised target returns a bit, but I think it's just at the margin. So largely that side of the house has not changed significantly. It's really on the other side where expectations of investors and et cetera has gone up in terms of return targets. So no, it's not really any real change with respect to the credit box of the various lenders.
Okay, great. Thanks, Dave. And I just wanted to follow up on some of the discussion around the loans on the balance sheet. What's your assumption for where that goes for the rest of the year? Do you plan to simply allow those to mature? Or are you going to kind of sell them into the market and when you have the opportunity? Just any thoughts there would be great. Thank you.
I would say, those are being held as, held for sale loans. Obviously, it will be a function of, what that secondary market looks like. And we will, we'll make an economic decision on them, but I think the preference would be to get liquidity and get cash back on the balance sheet rather than to hold the loans and earn interest income.
Okay, great. Thank you, Dave. Thanks, Sanjay.
Thank you.
We take our next question from David Chiaverini with Wedbush Securities.
Hi, thanks for taking the questions. I wanted to ask about the recent change to your loan modification policy in which you made it easier for Upstart borrowers to obtain forbearance, and these delinquent borrowers would be considered current on their loans. Can you discuss why you made this change, and are delinquent borrowers automatically entered into the forbearance program, or do they have to opt into it?
Yeah, thanks. This is Sanjay. So on loan modifications, I guess a simple way to describe it is, and even independent of the macro environment, we had certainly through the early days of COVID when unemployment shot up and there was a lot of requests for forbearance, we have a lot of data that led us to conclude that you're generally better off creating, in times of, call it macro stress, creating flexibility for borrowers and helping them work through those periods of turbulence. And I think in rough terms, if you charge off a loan, you're probably getting something in the order of 10 to 12 cents a dollar on the recovery. If you run an effective forbearance program, you can get on the order of 30 to 40 cents on the dollar. So we had plans anyways to begin to optimize the way we managed modifications and forbearance. But I would say that this macro environment accelerated those plans because it's made it that much more valuable to the borrowers. It's not an automatic enrollment thing. It still does require an application and a review. But I would say we evolved and we loosened our standards to make it a program that was sort of more widely applicable.
Great, thanks for that. And my follow-up question relates to the fair value adjustment. It looks like in 2018, when interest rates were rising, the fair value adjustment was about a $40 million headwind to revenue. And then when interest rates fell, the fair value adjustment was about a $30 million tailwind in 2021, which probably would fall right to, the bottom line of EBITDA. Could you discuss how we should think about that line item this year and how it impacts your EBITDA forecast given the rising rate environment?
Yeah, sure. I guess so. That's always been, I would say, a small component of volatility on the P&L. As you know, it's sort of deprioritized in our business model. The reason of the magnitude for it in 2018 was a bit of a technical one. In the early days of our securitization program, we were doing risk retention ourselves because we were a relatively new entrant into the market. We couldn't convince anyone to do it for us. So we had to consolidate a lot of those securitizations onto our balance sheet. And as a result, there's sort of big positives and big negatives. We didn't actually have any economic exposure to those deals. So some of that is a bit optical. I would say in 2020 and 2021, you can see our balance sheet reduced quite meaningfully. Some of that is just the deconsolidation of those ABS deals. The way I would think about it going forward is it's sort of a function of the scale of our balance sheet and what's going on in the economy. So for right now, the scale of our balance sheet is a little bit bigger than it was last year. And obviously, when you put loans in the balance sheet, there's two different accounting treatments. Our particular accounting treatment is we mark our loans to market every quarter. And so when interest rates, you're holding a loan and the interest rates are going up, you'll take a fair value hit. And so that's what's happening right now. I guess the answer to your question depends a little bit on what happens to interest rates, obviously. If they continue to go up, and in particular, as Dave mentioned, the one that's particularly relevant to us is the 2-year Treasury. So it's about 250 basis points higher than it was late last year. If that's topped out and it's stable, we shouldn't see any further fair value devaluations. But if we're holding loans on our balance sheet and that number continues to go up, there will be further devaluations. So I guess in the grand scheme, I kind of view this as, it's going to create some positive and some negative volatility from year to year. I think in the long-term sort of framework of the business, we don't really view it as meaningful to the business opportunity we're trying to execute against.
Thanks very much.
We move to Arvind Ramnani with Piper Sandler.
Hi, thanks for taking my question. I just wanted to ask about, some of the topics you've talked about where, you're putting loans on your balance sheet. And I know, Sanjay, you clarified most of it is more for R&D, but there's some, kind of some portion. I don't know if you're able to sort of quantify what's R&D versus kind of just taking on kind of regular risk. And then the second part of the question is, under what circumstances should we see that number go from the single digits to the double digits? Is that possibility, on the table, as we look out for the rest of the year?
Sure. Yeah. I guess the answer to the first question, Arvind, is I think in Q1, probably about 3/4 of our loans are R&D. The majority of what we balance sheeted was still in the auto segment, which we continue to still be sort of the R&D phase. What are the potential future scenarios? It's a good question. To some extent, it depends on it's a function of the level of dislocation in the economy and the progress we've made in, I would say, automating our platform's ability to react to new market clearing rates. So, in a world where our platform exists as it does today, and there's, further sharp shocks to the interest rate, and what's happening is, the prices on our platform are not reacting in real time to the return requirements of the investors as they're changing. That's the situation in which our balance sheet has sort of stepped in to create stability. So, I hope that on the one hand, we're creating more of an automated mechanism in our platform's ability to react to those changes in the economy. So they would happen, in real time. Investors maybe at the limit could just set their own rates as they change. And And, it sort of depends also to some extent on the stability of the rates and the economy. So those are a bit hard to judge, but, it's sort of a real-time, equation for us as the environment changes.
Great. And then just to follow up on auto, I remember we had met in New York, maybe it's been a couple of months now. One of the topics we discussed was, auto, you kind of look to take the large portion of the auto loan, to kind of work with the banking partners. Is there like a timeline change, just given circumstances have changed quite a bit in the last couple of months, or you still feel like you can stick to the original sort of time frame?
I don't think that's changed. I mean, we've kind of thought of this year for the refi product, we are bringing lenders on. I think we have 12 signed up now. So our first priority is bringing lenders onto that platform, and we'll do that through the second half of this year. The auto retail product is different and much earlier, and I would view that as something where we'll move toward bringing lenders and on and toward the beginning of next year. So there are different time frames, but I don't think our expectations for either of those products have changed.
Terrific. Thank you.
Moving forward to Shabdi Sarafi with FBN Securities.
Yes, thank you very much. So I was impressed by your 18% sequential growth in your average loan amount. And so it hit $9,700, but you were at $13,000 at the beginning of 2020. Do you think you can approach that number anytime soon?
Hey, Shelby. Go ahead.
Oh, no. Why don't I start? We don't expect that. I would not expect it to go back to 13,000. I think basically as our systems get better, approving more people at the margins, you're going to trend toward smaller loan sizes. There's a lot of good things about having better support for smaller loan sizes in terms of what people need. We're now launching the small dollar product, which is of course even smaller. So I don't see a dynamic other than maybe a short-term thing here and there that would drive loan size up significantly. It can be just driven up, by demand, and we may get some high-quality, very prime bank lenders on the platform, which would typically have larger average loan sizes. So it can be some puts and takes like that. But if you looked across the whole platform and you look across a significant period of time, it's actually kind of hard to imagine, loan sizes going back to where they would have been back then.
Okay, and my follow-up is that the loan amount on your balance sheet is about $600 million. So can you say at least that was a high watermark for the year, or that's going to be the high watermark for the year, or do you think it can grow meaningfully over the next couple of quarters?
I don't know that we could say that that's the high watermark. I mean, our plans to continue with R&D programs. The demand there is growing as we get out of the auto refi sort of balance sheet program. We're going to start to shift some of those dollars to auto retail as they become more significant later in the year. And as Dave said, we think we'll be in market with small business lending. These are all programs that investment markets and banks are going to want to see some amount of curves and history before they start investing significant dollars, so that they, in our view, will require some incubation. And the other side of the equation is that the economy does remain very fluid right now, and if we do need to step in with our balance sheet to stabilize the core business, I think that's an important tool for us. I don't think we would ever do it in any way that started to exhaust our capacity or even come close to it, but it is a tool that, although it's not our objective, it's an important stabilizer of the business as when the waters are choppy, so to speak.
Okay, thank you.
Next question from James Fawcett with Morgan Stanley.
Hi, this is Sandy Beatty on for James. Can you remind us how the usury limits impact what your platform can do, particularly for those lower end consumers? And I guess, are there scenarios where you run into issues here just in terms of capping what would otherwise be approved as APR offers move higher? And how does it impact your market share trajectory?
Sure. So basically, there's 50 plus lenders on the platform. They each have their own sort of statutory arrangement they operate under. It could be state chartered, could be nationally chartered. So they have different rate caps that they observe themselves, and we have no say in that whatsoever. If you look across the entire platform, we have made a decision a long time ago that we don't support any lender originating loans above 36%. So that's the statute that all sort of nationally chartered banks are under, and we just kind of made the decision a long time ago. That's where we want to put the limit for the platform overall, so we can control that. So the bottom line is, when there were a lot of people that 3 months ago might have been approved close to 36% that today would not be approved at all. So for sure, when rates go up and return hurdles go up, it has the effect of pushing people out of the approval band and into the decline band. And that's just the nature of the business. And when the model gets a little smarter, it will approve some of them and it will disapprove others that it might have approved before. And that also is, the nature of the business, the nature of the product getting better. But that's the bottom line. We don't per se have any say in what a bank or a credit union's maximum APR is. That's a function of both their own business model and their own regulatory regime that they operate under.
Got it. Thank you. And just as a quick follow-up, take rates. In a tighter funding environment with downward pressure on conversion, is there a scenario where we could see changes to unit economics just within that funding backdrop? Just wanted to make sure I asked.
Yeah, hey, Sandy, it's Sanjay. I guess the short answer is yes. As macro environment becomes more challenging, you might see us become more conservative in how we're managing the business, and that could result in higher take rates or, bigger, larger unit economics from, lower marketing operations costs.
Got it. Thank you.
We take our final question from Matt Schindler with Bank of America.
Yes, hi guys. So you mentioned that you outperformed heavily during the pandemic because of stimulus. It makes sense. And now your loans are showing signs of underperformance, particularly in the worst, the lowest quality loans, the lowest FICO score loans, I'm guessing. You did, though, the bulk of your low FICO score lending really started late last year. And what does that mean for the performance of your entire portfolio of loans that have been 2022 or later? Are we looking, or maybe even Q4 2021 originations and later, are those going to be even significantly worse than you're suggesting because they're weighted towards those lower quality loans?
So Nat, a couple things of clarity because the statements you're making aren't entirely accurate. First of all, most of the effect we saw from the decline, from the sort of retraction in stimulus, was across the board, all flavors of loans. So, there was some marginal difference between the highest risk loans and the lowest risk loans, but largely it was an effect that we saw that was universal. And for us, it's a very clear sign that it's a macro effect. So that's one important thing to say. Another important thing to say is it actually has nothing to do with FICO whatsoever. It's really by our own risk grades that we look at these things. FICO, and you can actually see this in some information we put into the investor deck. Our risk separation was dramatically more than FICO, so it's not really related to FICO scores whatsoever. But there you have it. I think that we're very happy with how the model is performing now. It has been stable, as Sanjay said, for the last 60 days. I think the bottom line is when you go through a period where the government essentially pays everybody's salaries for most of a year and then suddenly stops, it's a pretty damn difficult thing to calibrate exactly right. And so I don't think we're exactly right, but our risk ranking has been exceptional. The product is stable today, and none of our banks and credit union partners have seen any underperformance. So overall, we're actually feeling quite good.
What's the risk of something like? Oh, sorry.
Right now, it's just going to maybe again describe. I know you're sort of the direction you're heading in, but the effect was broad, as Dave said. It was maybe slightly more on high risk loans than low risk loans, but the real relationship to cohort performance is on timing. And by that, what I mean is if you're if you're an investor buying happily or a bank sort of originating happily across the past couple of years, what you'd see is probably 12 vintage quarters of overperformance. The ones that were timed right around the injection of the stimulus, so call it late 1919 to sort of early 2021, those will overperform dramatically. So maybe kind of like 2x the return target. And then the sort of the 2 or 3 vintages that were right around the time of what we call the reversal of the loss trend, and you could see this in our investor deck. It was sort of like, the Q2 and the Q3 2021 will marginally underperform to the tune of, we'll call it, 20%. So really the underperformance we're talking about, it's tempting to kind of want to relate it to the change in mix we've had over the last year, but really what it is it lines up almost exactly with the injection and the sort of the evaporation of the government stimulus. And as Dave said, there's marginal differences between the low and the high end of risk. But I think that's the secondary story. It's not the main driving effect here.
Would then it be reasonable to assume if student loan forbearance ends as expected, that it would have a compounding effect on this? It would be the opposite of stimulus?
If forbearance ends, meaning if they start demanding the repayment of student loans, or if they forgive student loans?
Start demanding repayment again. As expected.
Yeah, I think
it's still unknown what they're going to do, but it keeps getting delayed. So.
Yeah, I think that would be another example of reversal of stimulus, right? They've sort of allowed forbearance for a long time, and so I think it would just maybe be a continuation of the trend I'm describing. I think the majority of the excess balance sheet in our economy has been unwound. You see, like the personal savings rates, they shot up in a couple of different instances over the course of 2020 and early 2021, and those savings rates are right back down to where they were before. So, there may be some, maybe not all of the stimulus has been drained out of the economy. You could sort of describe it that way, but we think a lot of it, if not the majority of it, has. And so there may be a bit more to go, but as I said, we've seen stable trends now for a couple of months.
Okay, is there any those demographic are you more demographically targeted towards younger people who are likely to be, to have student loans, or are you more broad, or are you targeted somewhere else? Just wondering how big of an effect that could be on your borrowers.
I would say in the past, we definitely, like the inception of our company, largely was around thin-file borrowers, but I don't think that's the case anymore. I think we have a pretty broadly distributed portfolio across the risk grades and the demographics now. So, I don't know. I think it's the biggest, platform in this space will probably be. I think you could imagine trends will be roughly proportional to the general population on our platform at this point.
That makes sense.
Thank you. It appears there are no further questions at this time. I'd like to turn the call back to Dave Girouard for any additional or closing remarks.
Just want to say thanks, everybody. We are actually quite pleased and quite happy with the results. Definitely appreciating also that 2022 is a complicated year in the economy and a lot of open questions, but we are exceptionally confident in the strength of the business and is optimistic about our future as we have been. So thanks to everybody for joining us today.
OK， 终于完了，我要快点讲，要下线了，因为小孩要开始上学了，准备吃早饭。那个问题太多太长了，而且这次的问答总体比较有技术性，所以有些可能再重新看一下它的财报，然后再具体讲。我觉得首先这种就是股市短期的反应就不去管它，就是最终还是一个问题，就这家公司的基本面有没有变化。什么叫基本面呢？就是说，比如说，它跟传统的那个 FICO 的优势，还是不是存在？我相信这张图，我觉得它加得很好，就表示这两者之间其实有很大的差距，而且在扩大，肯定没问题。那长期的增长有没有问题？它今年所谓降低了8%，1.4变成1.25，降低了之后，全年增长仍然是47%，这仍然是高速增长。而且 CEO 也讲了，说他可以很明显的看到，几年之内公司的收入可以到达10个 billion， 他现在才1个 billion， 所以就是未来的，就是只要过去这段比较波动性这个经济的波动性之后，这种巨幅的利率的快速上升，虽然绝对利率不高，但是它的上升速度比较快。这段时间，所以市场产生了很多噪音，所以它要比较谨慎。就是说总体的增长，长期肯定没问题，因为它未来还有好多产品要推出。第三个就是说，要不要担心它的盈利问题？这个桑姐也讲了，对吧？它其中很多就说全部我们人员增加，产品增加，因此呢，就是说费用的增加超过了收入的增加，这当然就影响了那个利润但是这是对一个增长性的公司，这总体是好事，所以这也不是问题。然后还有很多问题讲的 ABS， 这个我们其实讲的差不多，对吧？他说 ABS 不是我们做的他一级的那些机构，然后把自己转手再卖出去，所以最后 ABS 的 performance， 第一个现在没有问题，第二个有点小问题，比如短时间，比如说有1个月可能高一点，也是那个一级机构跟 ABS 市场之间的问题，不是 Upstart 的问题，所以这不是问题。还有很多问题问的说他这个就是为什么把一些贷款放在自己的那个账上，然后我们之前讲过，他有一部分一直是这么放的，比如说那新的产品，他推出之前，就是在卖机构之前，他要自己在自己那个保温箱里做实验，看效果怎么样。但这个季度唯一不同就是它增加大概1%的有一些比如说这个市场这个波动比较大的情况下，比如说人家还要消费者要贷款，这边机构可能短时间可能需要的那个风险cover 的更高一些，所以他可能这个时间不平衡，他就把这一小部分放在自己的账上，然后等以后再有机会再把它卖出去。所以我觉得这个只要长期不增长也不是问题，所以这就是我的感觉，就总体我的判断就是说增长长期没问题盈利长期没有问题。现在的所谓的还是之前讲是投资引起的短期的盈利的下降，然后它长期对 FICO 对其他的公司的优势仍然是非常明显的，只会越来越大。所以呢，这是我对总体的判断就是看大家有什么特别着急的问题，然后没有的话我们就回头再说了，因为5点45了已经就是这个问高速增长仍然是会高速增长的，要不然CEO 不会讲我们几年之内收入可以到10个 billion 可以涨10倍。但是呢，高速增长不见得每年就是必须是就是50%、60%不变的增长。对这个预期的下调，就是管理层讲得很清楚，就是主要是对宏观经济的判断。不要用 margin 了，说过了。Operating expense 涨得很快，这个他已经讲了，就是说他是招人，然后新产品上市，所以他的那个费用增长会超过收入增长。这种是说他在增长的时间，这其实是好事。他如果一旦增长，如果是费用不增加了，可能反而有问题。对，快速增长企业是这样的，就是说它只要有威力，我其实就没有问题。对，那个分析师很多，这个水平确实很有限，就是 这就表明这家公司的问题，就是它本身，因为大家对 FICO 那个系统是非常这么多年30-40年非常信任，所以你现在突然有一个什么 AI 算法，然后打破这个，然后它的商业模式呢又需要，就是这边是机构投资者，这边是消费者，它的中间又有银行，所以相对比较复杂。你看大家问的问题很多也比较技术性，很多人其实对它的模式还是不了解，所以呢，分析师的问题质量也比较差。这就是为什么说这个公司比较难理解。股票回购没有提所以这点有点我不知道为什么没有人提这个。它应该有回购，但是要仔细看一下那个数额，我要看两个财报的比较，看它到底回购了多少。我估计它4亿美金应该没有全都用完。这个说过了，预期下降。汽车贷款没有讲，就只是说汽车贷款到年底会占很大比重，但具体多大没有说。如果 margin 报酬，我没有做过 margin， 所以很难给操作建议。就是还是那句话，就是对于公司不管怎么看好，不要做 margin 太危险。OK， 所以我会睡几个小时，然后起来再看一下财报，然后把一些重点东西再捋清一下，尤其一些比较技术性的，可能大家不太容易理解的，比如说讲 ABS 的，讲他为什么把那个账贷款放在自己的账户上，资产负债表上，还有看有没有他对汽车贷款的具体信息。第4个就是他对回购到底力度有多大？这几个问题我再看一下财报，然后有具体的东西我再跟大家讲一下。说如果没有问题的话，接近6点我得下线了，因为小孩要开始准备上学了。OK， 好吧。OK， 谢谢大家我们一会儿再见，拜拜。